But remember, none of this data, our data or their data, is adjusted for population. So if you look at inventory on a per capita basis, it should really be quite a bit higher than what's considered normal of the 1.2 million active listings. So all of these charts that I've shared with you on the show are not adjusted for population size. Now, I did do a study on that, and I can't remember if I've shared it on the show yet, but I will. Okay, I'll share it again because you kind of have to repeat yourself a little bit for people to get it. You got to keep beating the drum. But suffice it to say, 45 million increase in population. What does that do for housing demand? Well, let's take a look. So the immigration is the wild card, right? We've talked about that, but just take a look at these projections. This green line on the chart is population growth. Then you have net immigration, and then you have births minus deaths. And a lot of the doomers, right? A lot of the crash bros, they're saying, oh, well, the baby boomers are going to die off, and that's going to leave all this extra supply in the market. Well, I've addressed that. I shared with you a John Burns real estate consulting report. And, again, his specialty is consulting for real estate developers because they have to decide far in advance how much land should they be buying? How many homes should they plan to build? How much supply of building materials will they need? Lumber, concrete, copper wire, glass, steel, et cetera, et cetera. They have to decide this stuff way in advance. And they have to make big business decisions based on that. But here again is the data. And remember at the beginning of this episode, I talked to you about how you'd really have to start to get cautious in the 2040s. Well, I'm probably wrong about that. It depends how much building takes place between now and then. But if you just look at population, here's where we're going. And by the way, these numbers have been scaled back because we're looking at 342 million people today, okay, and 373 million in 2053. That's the population numbers. Now, again, how much housing stock will be built? How much existing housing stock will become obsolete? It'll just become too old to have any real economic value. These are all the questions in play. But remember, the 2050 projection for population used to be 400 million in the United States. It's been scaled back to only 373 million in the US by 2053. It used to be 2050, 400 million, 3 years either way, not a big deal. All right, so that's what we're looking at. And then we have to ask ourselves, well, where? The US is a giant country. Net migration, domestic migration by county, right? This chart shows you where people are going and where they're leaving. They're typically, very generally leaving cyclical markets. They're business unfriendly markets, landlord unfriendly markets, high tax markets, high what I call government intrusion markets. And they're going to lower density markets that are more linear in nature and that are more landlord friendly. So that's where you should invest. All these are the right markets. And by the way, you can find a lot of these great markets that we like at jasonhartman.com/properties. And you can see great investment opportunities in these markets. Okay, a 10-year situation of low supply. If you look at this chart, this is from the Fred website. It says new privately owned housing units started. These are housing starts, and they show you that from about 2006, where we reached our peak of construction, we saw, as the Great Recession came into play, just a massive, massive decline in construction. And you know what? It took a long time for builders to start ramping up that supply side, again, with new housing starts. And they still haven't even really come back to the prior levels. But why is this important? Well, it's not about what the construction is today versus back then. It's about all the years of low supply that created this ongoing deficit of housing supply. Now, one of the more conservative estimates on the housing shortage is Robert Dietz, with the NAHB, the National Association of Home Builders. He's been on the show before, and you heard him talk about this. And his estimate, or their estimate, is really quite conservative compared to some other estimates. They estimate that we have a shortage of 1.5 million housing units, and others say 4.4 million units, right? That's according to Fannie Mae, the biggest mortgage player in the entire world. And up to 7.3 million units is estimated by the National Low Income Housing Coalition. So whatever you think the housing shortage is up for debate. But the point is, there's a shortage. And it just cannot be denied that there's a housing shortage. Now, the other issue you get is you get the price range issue. You get the price segments that vary dramatically. And this housing shortage is the most acute in the low income entry level housing segments. Okay. And you see during COVID, that housing supply contracted dramatically and the building stopped, but then it restarted. We had supply chain problems, et cetera, et cetera. They considered, home builders and home building to be a necessity thing, so they didn't constrict them for too long, the building. But again, where we are now is we are just not able to address the housing demand, and the structural, pardon the pun, housing shortage continues. Renter Nation can talk about this. Well, remember, multidimensional asset class. So prices and rents, non-correlating indicators, or I guess they have a reverse correlation, right? So when you have a lower home ownership rate, you see people forced to stay in the renter pool, or new adults moving out of the house, leaving college, whatever it is. They are renting rather than buying, the new households that are formed. And so we have a lower home ownership rate and a higher percentage of renters, which pushes rents up. Congratulations, investors. That's exactly what you want. You want to serve this segment of the population who needs to rent, and they're going to pay you higher rents. Multidimensional asset class, even if prices don't continue to go up. Don't be the shallow crash bro that's all about prices. Understand the multi-dimensional nature of income property. And then you look at this. Houses are too expensive to underpin lofty rents, right? I mean, look at this. This is like just playing right into our hands as investors, right? This chart says median US rent increase or decrease year over year. Single family homes and apartments. Now, we know that apartment supply is very oversupplied. We have a record number of new apartments coming online this year, and we see rents softening in the apartment market. But it's interesting because I looked at some apartments recently to do some market surveys of my own. And oddly, I don't see much distress in several major cities in the apartment market. But again, this is location dependent because, as the old saying goes, all real estate is local, whether it be prices or rents or certain price segments, it's all local. All real estate is local. And remember, the only apartment supply that is being built is Class A, because they won't let you build Class B or Class C in the apartment market. Haven't been allowing that for literally decades. Now, Baselane, our sponsor, it is the #1 banking platform built for real estate investors. It's banking, online rent collection, bookkeeping, tax reporting, analytics, and more. You can enjoy real-time cash flow analytics on your properties. You can get ready for tax season with automated bookkeeping and financial statements ready for your CPA. Join more than 40,000 real estate investors who trust Baselane to manage their rental property finances. Go to baselane.com/Jason for a chance to win a $500 Amazon gift card. Okay, houses for rent are benefiting from the least affordable home sales market in many decades as a result of sale prices reaching new record highs and mortgage rates hovering near a 2-decade high. That's exactly what you're seeing. Houses for rent are benefiting from this lack of affordability high prices, high rates. And investors, you are in this wonderful multi-dimensional asset class. So there you go. And you are buying. Investors bought 26% of the country's most affordable homes in the fourth quarter of last year, the highest share on record. Even during the go-go times when prices were going through the roof during the pandemic era, you have now purchased more than at that time. So crash bros be damned. You're just wrong all the time. You're just constantly wrong. If you consider investors to be the smart money, remember, this includes institutional investors, not just mom and pop investors. You're buying 26% of the country's most affordable homes. Good for you. Price tiers. Let's segment by price tiers, because of course, the entry level housing is where you want to be as an investor. That's the best part of the market. And this Redfin study shows you again that that is what investors are buying. They're buying 26% of the low price segment. They're buying 16% of the high price segment. Even the high price segment investors are buying. And then they're buying 14% of the mid price market. So there you have it. Okay, investors bought nearly 1 of every 5 homes sold in the fourth quarter. Okay, and this is overall in all price segments. Investors bought 18.5% of US homes sold in the fourth quarter, up from 18.1% a year earlier. Their market share likely rose because they didn't retreat as quickly as individual buyers. Okay, so there you go. That's the overall investor market share, but not the affordable investor market share, which is much higher. Back to the housing shortage discussion. Here's what 11 major researchers think of the housing supply in the US. Fannie Mae, the biggest mortgage player on planet Earth, thinks we have a housing shortage of 4.4 million units. Zillow, they're huge, obviously. They think we have a housing shortage of 4.3 million units. Bank of America, one of the big banks, obviously, one of the biggest banks in the world, thinks that we have a housing shortage of 4 million units. Freddie Mac, the second biggest mortgage player on planet Earth, thinks we have a housing shortage of 3,800,000 units. Realtor.com, 2.3 million. Morgan Stanley, 2 million. JP Morgan, 2 million. John Burns, 1.7 million. Moody's Analytics. And by the way, folks, all of these people have been represented on the show. Okay? Every one of these firms has been represented on the show over the years, whether it be Lawrence Yun with NAR, which says we're 3 million units short, or Bank of America, or Freddie Mac, or any of these, right? They've all been represented on the show before. John Burns, been on the show many times. 1.7 million units. Moody's Analytics, they've been on the show. 1.7 million units. Zonda, which is owned by my longtime friend, Jeff Myers. He's a former client from years ago when I was very young in the real estate business. 1 million units. He's the most conservative. You know, he doesn't think the shortage is that bad, only 1 million units, but all of them say there is a shortage. And then there's some more data on it. Okay, folks, let's wrap it up for today. So we will say over and out. Thanks for listening. And if you have any questions or are looking for good investment opportunities, of course, go to jasonhartman.com, reach out to one of our investment counselors. They can help you. And also consider joining our Empowered Investor Pro group, where we have monthly Zoom meetings and we can really dive into self-management and a variety of other resources for you as investors. Also, one more thing, never miss our free monthly Zoom meetings. Again, these are not webinars, they are Zoom meetings, so you can interact, you can get your questions answered. This month, we've got Tom Wheelwright, author of Tax-Free Wealth and the Rich Dad Advisor series. He's a great CPA with a lot of good information, and he'll be on with us for over an hour coming up. All you do to register for those free Zoom meetings every month is go to jasonhartman.com/Wednesday. jasonhartman.com/Wednesday, because they are the second Wednesday of every month. Until next time, happy investing and stay empowered.